There has been a call for boards to lift their corporate veil and be more open to shareholders. It comes as some of Australia's largest listed companies want to increase directors' salaries after years of restraint from the global financial crisis. The Australian Council of Super Investors represents $300 billion of retirement income from across 39 super funds. I spoke with Phil Spathis, Manager of Strategy at the Council, and asked him how likely it is that boardroom salaries will be boosted.
Well, when a company submits a proposal to increase its remuneration pool for shareholder considerations, we take into account a range of factors as to whether or not it's reasonable to do so. We look at issues like, the extent to which there's been previous increases, when the last increases occurred, how big that proposed increase will be, and how, in fact, it will be applied. A few years ago, there was a kick in the size of director pool remuneration to take into account structural changes that came about through a range of governance reforms. Well, I think we also take into account in this day and age those sort of issues, but also the extent to which companies have been effective in their governance oversight. And of course, we can't ignore how a company has performed overall.
If you look at, let's have an example, say look at Asciano, the port and rail operator. They want an increase in their pool, their directors' fees from 1.5 million to 3 million. Now, given their last profit results weren't as good as many would have liked, their profit results were down. Why should these directors be rewarded, given based on their performance wasn't as good as what people would have hoped?
Well, look, the optics of that aren't exactly favourable, and the question has to be asked is why such a significant increase on the back of such poor performances. So we would encourage companies to actually utilise this regime of seeking the endorsement of shareholders to engage with shareholders directly and go beyond, I guess, the boilerplate disclosures that are submitted in annual reports, and reach out and explain the reasons why companies do wish to allocate a higher remuneration pool. It's only through this way we will get a better idea of how this remuneration pool will exactly be applied.
Asciano and other companies argue that they need the bigger pool to attract more people. How difficult is it to attract people onto boards?
Well, I don't think it's that difficult to attract people onto top 100 boards. There are directors who are clamouring there are people who are clamouring to get onto these boards. And
it's
so
very
I think
prestigious, and is it reasonably well paid?
Well, it is, and I think it's a very responsible position to hold a directorship of a top 100 board. There's a lot at stake in relation to the strength and longevity of the company at stake, and the flow-on effect it has on investors throughout. I mean, take our industry at point, 40% or thereabouts of Australian superannuation fund investments are tied up in the Australian equity market. So therefore, there's a lot at stake in that regard. We are happy to see directors well remunerated, but it also has to ensure that there is commensurate performance in the way they manage their executives. And so from our point of view, we want, I guess, the confidence to ensure that directors run their CEOs and the executives and not the other way around.
What's the feeling amongst the institutional investors about this push for higher directors' salaries to increase it?
Look, I think overall, we've been reasonably well served by our directors. However, I think we've come out of a period where there was a bit of a lull in the increase of director remuneration, and I guess we are very acutely aware about any sort of catch-up that may apply when we're still not out of the woods when it comes to, I guess, a very demanding and stretching environment.
Is there an imbalance in a way in the way boards operate? You've got boards that consider themselves as the guardian of the company, of course, but then the company is actually owned by the shareholders.
Well, look, we do not want to be stepping into the shoes of directors. They are fiduciaries for that very reason, that they have an unequivocal position in the law and in practice to basically act in the best interests of the company and in the best interests of shareholders. So we elect these directors to do a job. So we want them to be paid well, and we want them to basically provide effective oversight on strategy and implementation position when it comes to decision making. So we make no bones about it that there's a lot at stake here, and so it's incumbent on boards and directors to follow through.
Are boards largely protected? Because it seems when something does flare up, boards can often say, well, we didn't know, the board didn't know about it, and it seems to be that you have to take the board's word for it.
Well, we've got to ask questions of each of our boards, and we do that quite extensively and more so proactively as time goes on. We actually ask them what processes they have in place to basically ask what you call the stupid question. Because there is no such thing as a stupid question, only stupid answers. And so we really have to sort of dig a bit deeper through our engagements, as we do with chairmen, to ensure that boards are equipped to be able to ask those questions. And look, quite significantly, there's been improvements in the representation of new blood on boards. You've had, in the last 2 years, more than 50% of new incumbents on the ASX 100 coming from outside the ASX 100, which is a very positive sort of move. However, we sit dismally low in relation to the representation of skilled women on boards, and having only 11% representation of women on boards means that, from a very specific economic argument, we are not tapping into the available resources in the economy to be able to get necessarily the best people on these boards.
Phil Spathis, we'll leave it there. Thanks very much for talking to us this evening.
Thank you.